Uh, so good afternoon, everyone. So this is Pankaj Kumar from Kotak Securities. Welcome you all. So at Kotak Securities, we are doing analyst presentations and corporate meetings during non-result season. So this is a new initiative as part of our value add to our elite clients of Kotak since last quarter. So in this session, we are glad to host the management of Praj Industries. From the management side, we have Mr. Shishir Joshipura, CEO and MD, Mr. Sachin Rawle, CFO, Director of Finance and Commercial, and Mr. Sandeep is IR. This session will start with a brief opening remarks from the management team. This will be about the company's business out and industry outlook. And post that, we'll open the floor for interactive session where you can ask the questions by raising hand or unmuting yourself. You can also mark the questions to me and in the chat box, and I'll take them one by one. So first, I'll hand over the floor to the management. Over to you, sir. Sir, you are on mute.
Good afternoon, Pankaj, and thank you so much. Thank you, everybody, to be present in this call. We will start by sharing with you that what we have shared in our past call, no fundamental change in any of the indicators, market drivers that we have talked about. The development on the domestic ethanol front continues to strengthen. We are seeing that in our inquiry inflows, we are seeing that in our order book build-up. So no reason to believe or of any change in direction or winds that are propelling this demand forward. On the international side, we are still to see opening of economies. Everybody has a different scale of opening up, but we are watching it closely to see how the international economies also come out of these pandemic curves that everybody has at differentiated levels. In our other businesses, we continue to see positive traction build, whether it is on zero liquid discharge business or on high purity business. And no change in status except a minor change on the brewery side, that we are now beginning to see some inquiries start to flow up, which was more or less a shutdown case for all this while during the pandemic times. So some initial inquiries now visible on the brewery side. Other than that, we don't see any significant change happening. We probably noticed the UP Chief Minister inaugurated the CPG plant that we have built at IPL in Muzaffarnagar. So the first such plant in the country. A lot of interest. People are watching the whole ecosystem, how it starts to function. And as I speak with you, it is beginning to scale up now. So we already started the scale up process a few days back. So all in all, positive vibes for the business continue. As the challenges that we said about rising commodity prices, so still we have seen that is still on an upward trajectory. The raw material prices, so that is a challenge that we still need to continue to overcome. And international businesses or the international business is going to open up at different points in time, at different levels in different economies, depending on how those economies are recovering out of the pandemic post curves. So that's brief from our end. Overall, very positive. Continue to build the momentum. Domestic ethanol story still intact and building momentum as I speak with you. And we'll be very happy to answer any questions that you may have. Of course, we've also seen some more advanced announcements around the ecosystem of the green hydrogen related announcements, and we are very happy with it because there's definitely a long-term development that will help further the cause of bioeconomy and clean energy. So, and Praj is a very, very keen player in that space. With that, I'll hand it over to you for your questions. Very happy to answer me and Sachin, whatever we can.
Thank you, sir. So the floor is now open for the question and answer session. So I would request the participants to ask the question. For that, they can raise the hand or even they can send the question in the chat box. I'll take them. So now it's open. Floor is open. So kindly raise your hand and ask the questions.
Pankaj, till the time questions are coming, can I ask one or two questions?
Yeah, please. Yeah, Rasmi.
Good afternoon, sir. So I just want to understand, whatever inquiries or orders we are getting, what could be the average size of plants of ethanol we are getting in terms of KLPD, and how many clients could have come on board in terms of ordering of new ethanol plants?
So, Rusmik, I think there is no fixed number that, because different people have different capacities. So we have customers who are setting up a 100 KLPD plant, and we also have an order for a 300 KLPD plant and a 500 KLPD plant. So I think it's a function of their proximity to raw material or feedstock, as we call it, for their access to that, their access to the blending markets, how near or far, how deficient the state is. So there are different factors that drive the capacity decision on a plant. So there is no fixed number that I can say, okay, no, this is the average capacity of the plant. And if I take an average of all the orders that we have got, that would not be representative of anything. So it's a broad band between 100 to, most of the plants would fall between 100 and 300, a couple of them above that, but most of them between 100 and 300 kiloliters per day. What we're definitely seeing is a much more push now coming forward on grain-based projects. Some of the sugar customers are also now creating a dual feedstock plants where the sugary feedstock and starchy feedstocks both are being contemplated for the year-round running of those plants. So that's another development that is taking place in the market. The sugar customers are also now saying that we would like to also have an option for grain built into the plant, so that they can run the plant for the whole year. I'm not able to because any number that I give will be a strict misleading number. It's just an arithmetic average, won't be indicator of anything.
And a follow-up, sir, because we have been attending a lot of this sugar companies, calls and other things. Most of the large sugar companies, they're all trying to, see that the plants come on stream by November 22 so that they can benefit in the 22-23 crushing season. So on the execution side, do you see any challenges, or you'll be able to actually, implement and execute most of the orders which are there in hand at present?
So, Rusmik, we definitely not something that's happening now. This is a phenomena that is under development for most of this calendar year. So we had prepared ourselves in terms of our manufacturing capabilities, in terms of our project execution resources. Some bunching once in a while could happen because some orders may flow. In 1 week I may get 7 orders, and then next week I get 2. But on an average, so we are gearing up. We are fairly well geared up to execute these jobs on time. One of the track record and the reputation we have is we don't delay a project. So we are very sure of staying within the cycle time. What is definitely happening though is that some of the cycles are stretching. For example, stainless steel, right? So earlier, the delivery cycle of stainless steel was 4 to 6 weeks from the date we ordered on the steel mill. Is probably now 4 months. So we have to plan that much in advance. The good news is that we have an order book, so that allows us to order that in advance as well. So from that perspective, we are fairly well geared up to execute these in due time. So there is no problem whatsoever.
Thanks, sir.
Thank you, Rasmi. So next in line, we have Mr. Sachin Jain. Sir, you can ask the question by unmuting yourself.
Hi, Shishir. Good afternoon. Shishir, a long-term question. Raj is always very, very high on technology, superior technology. Maybe it reflects in your market share in ethanol space also, and you're talking about a lot of technology. But actually does not reflect in margins. So what is your idea of sustainable margin? Do you see a significant margin improvement over a medium term, say 3 to 5 year kind of time horizon?
So, Sachin, right now what you see is, of course, a bit of a mixed bag and on 2 dimensions. One is our mix of, because of this extremely strong push in the domestic market. We are witnessing a bit of a skew in favor of domestic sales away from domestic to international ratios. So international markets obviously do give us better margins compared to domestic markets. So that is one shift that has taken place. And in my opinion, at least we have to see this for 3 quarters of this year. So on this dimension. And then there is the other part, which is the absolutely runaway rise in the commodity prices. So we do not have contracts with our customers which allow us to go back to them and ask for increase in cost. So while I'm able to accommodate the current price in my current quotations, the way the steel prices have gone up, I mean, literally every third or fourth day there's an announcement of the price increase. So that's a bit of a challenge that we are trying our level best to overcome those situations. But yes, that is definitely impacting our margins, at least on a yearly basis, by 2 percentage points. So that's where we are. If we move forward, and I'll build on the question that you said, yes, of course, if technology is the base on which we are selling over a period of time, as we go into what I would call as more complex solutions, more differentiated outputs from the plants, we do see a shift on the positive sides, because obviously those solutions will attract better margins. How much better is a factor of mix and the commodity price changes, the cycle in that particular quarter, etc. So I won't be able to put a number out, but this is the real situation right now. That we, as you know, that at the beginning of the year we had a very solid order book, and that some of those orders have been executed, but some are still under execution, and some of those are impacted with this massive steel price hike that we've seen. So that is definitely impacting our margin. But this is not definitely the representative part. In a more normal scenario, we will not have these factors. So to that extent, we should see improvements.
So does that mean, Shishir, once a commodity inflation is taken care over a period of time, maybe in a longer run, maybe 15 to 20% kind of EBITDA margin kind of possibility? Because I'm more thinking of one operating leverage play, because Praj historically last 8-10 years probably not much top line growth, but now orders started building in. And second, I believe more proportion of international and other products, more service-led offering also. So in a long run, probably can we build in over a long period of time a margin which is far, far superior? I'm not talking about incremental margin, but maybe a far superior margin from where it is today.
Sachin, as you rightly said, we have taken actions, we are initiating actions to see how we can improve the value for customers and even capture part of it. That is definitely a constant attempt at our end. The mix changes, as I already mentioned. What is the exact impact is a matter of what is the exact point at which all these needles sort of converge, right? So I will not be able to put a number out there, but our effort also is to see that we go from here, we improve our numbers, and of course, also the leverage impact that you are mentioning to is also realized. Of course, our top line numbers are growing at a decent pace, so we will see some impact of the leverage coming as well. Of course, right now, as we said, and you also acknowledge, is the temporary phase of the commodity price inflation, so which of course should not last forever. So at some moment in time, it start to stabilize, and then it should be okay.
One last question, Shishir. Your current capacity can take you up to what top line, and when probably you will have to think of new capex?
So the way we made our plan is that in capacity terms, in terms of our factory space, area under the crane, we are fairly well placed right now. The way we have developed our dedicated vendor base. So we are not looking at any significant capex, at least for the next 12 months. Nothing at all that is any significance. And we will see if the same pace continues. Then, depending on the product mix that arrives at our doorstep in terms of our business mix, because right now a lot of what I would call as manufacturing activities are dominated by what is required for the first generation ethanol systems. But as we move forward and other businesses also start to come in, and if they need some specialized investment, then we look at it at that time. Per se, for capacity increase, we don't need to go for any big ticket expenses of now.
Yeah. So one more last question, if I may, Shishir. Can you just throw some more light on ecosystem development on CBG front? Because pilot now probably there are 2 plants already up and running. So in your opinion, how one should see it, and when you believe that acceleration will happen in terms of more plants coming into probably more announcement on number of plants and how this overall ecosystem is getting developed?
Yes, so I think 2 or 3 things that we have seen, which is positive construct, is one, the customers who are buying, the eventual user of CBG is a very happy customer. I personally spent some time at the first gas pump, which is established on the Delhi-Dehradun highway by Indian Oil, speaking to people who are, filling their tanks with CBG in different vehicles. And all of them had very positive, and they were repeat buyers. So they had a very positive kind of a feedback to give, that very happy with performance. It does give a higher mileage, as packs a little higher power into the engine, so they can go up the tough slopes in an easier sort of fashion. So I think that's the first test that, yes, because if that itself had not passed, then it would be a very different cup of tea, but that's not the case. So I think that's number one. Number two, we are also seeing a lot of encouragement being given around conversion or increase the gas-based fleet, gas consumption in the country, improvement of gas-based fleets. But of course, all of this has to be coming up with A, supply of gas, and B, setting up the retail network, right? So that is an activity that is running parallel. We have learned that in a almost, if I can use this word in this positive sense, in an almost virgin market, Muzaffarnagar, in about 3 to 4 months' time, we are able to go to a good plant utilization level. So that's the kind of time it takes for the ecosystem or surrounding ecosystem to develop. We are also now seeing the next evolution of this model, where the fleet owners are beginning to get interested, because when they start to see one of their vehicles running more efficiently than others, then of course they are very keen about saying what can they do. So we will see that momentum start to build in, and I think that's a good thing to happen. Yesterday I was in Nagpur, and I was talking to some of the fleet owners about how they view the advent of gas, and they are all very keen, because they believe that if this can solve their high cost of operation problem, they would be more than happy to support the conversion of even the existing fleet, and that would further accelerate the availability. So that's one. On the other side, I think we have seen the announcement around CDG networks, 5% blend being made mandatory. So that's a very positive development, because CDG networks, when they're up and running, and if the blending takes place, I think that will make it very, very easy for gas to be dispensed. Then you're not worried about, as a producer, you're not worried about saying, if I produce, where it sell. So it'd be 100% offtake kind of situation. So early days yet, but what we've seen in the first example is very positive, very constructive. Customers have welcomed it, and I do believe that augurs well for moving forward, because that means that all the elements in the whole overall value chain have all got positive feedbacks about their own elemental play, and I think that's a very constructive sign. But as I've said in the past, CBG business in terms of its full-blown activity is still roughly 24 months away. Maybe it's a little less now, because I said 24 months a couple of months ago.
But in let's say next 24 months, what kind of potential you are seeing at industry level? Say maybe some rough estimate by you in terms of number of plants may get announced, or kind of capex, and then relevant opportunity for Praj in that sense.
No, so Sachin, I mean, the overall plan government wants is 5,000 plants. So that's very, very significantly large number. Even if you take it over 5 years, there's 1,000 plants a year. So I don't see 1,000 plants a year starting immediately, but definitely even if, I'm saying this, that let's say 100 plants come up a year, and that's significant activity suddenly added. There's 5,000 crore worth of activity that will get added in the market space side. So it's even at 100 plants a year is a significant number. What has to happen is I think there's a one plant commission. This is how the industry works. They said, all right, show me one more to tell me that it actually works. And there are no special costs that make this work. So that will also happen now. In October, we'll commission the next plant in south of India. In fact, I can only share with you one thing, that when the plant was commissioned and it was running and it was successful, one of the Indian Oil, which is the marketing company associated with that project, they have sent a very special team to actually, because this is the first project which actually went on stream apart from many that got announced, which got commissioned, and it is actually showcasing what is possible in terms of the potential of this particular stock. As we will commission in the last quarter of this year a straw-based plant for HPCL, that will also showcase what happens with straw and are there issues and how we manage the supply chain. So that is why I said that this year probably we'll see plants getting commissioned and confirmations for different hypotheses and the postulates that have been made. But as we move into the next financial year, probably things will start to strengthen and will improve from there onwards.
And the credit from banking side is also now a smooth affair for this kind of plants, because ethanol it took quite a long to figure out a solution. But for CBG, do you see it would be a bottleneck, or it is now a smooth affair?
What's the solution you were asking? Sorry, the packaging?
CBG, any banking side credit to anybody who's going to put a CBG plant?
Yes.
So do you see banks are not very reluctant, or it's easy to get a banking credit for this kind of plants?
Good. No, so the good news is CBG is put on priority list, so which is a good news by the Reserve Bank of India. So from that perspective, the banks know that this is priority sector lending, so that itself smoothens a lot of issues. What we are seeing is definitely an increasing interest from several ESG funds who want to be seen as responsible investors. They want to build some of these systems themselves to invest into the full time into the project. We are into active dialogue with a couple of them, and we are seeing increasing interest from some other quarters coming as well. But what will actually happen is once these 2 or 3 projects are commissioned, so then we are able to say, well, it's not operating only at one particular place, but is operating it in north of India, in south of India, on pressed mud, on rice straw, on spent wash. We would have covered all the potentially high potential feedstock. We have covered 3 regions, north, west, and south. That probably once that kind of a proof on the ground comes, we will see. It is my personal opinion that then we'll see a real credible development on the potential.
Yeah. Thanks, Shishir. Thanks for your.
Thank you.
Thank you, sir. So next in line we have Mr. Samir Palod. Sir, you can ask the question.
Yes, am I audible?
Yes, sir, you can
go ahead.
Hi, Shishir. Thank you for your time. Shishir, I have a sort of follow-on question to the earlier participant's question around margins. One is, there are 2. So when I look at your historical margins for the last 5 or 6 years, they were at around 10-11%, and they slowly trended down to 7%. And now you're sort of in the 7 to sort of 8 to 10% range currently. What sort of boggles my mind is that given the technological leadership that you have, and it seems to be primarily you in that market with a 50-60% market share, and the rest of the market is sort of giving up the rest of the 30-40%. Why is this a fundamentally low margin product? Then when we talk about being at the cutting edge of this technology, then why are the margins so slow? And one of the reasons you elaborated earlier was steel prices hit you, etc. But surely you will be able to figure out how much is the steel price impact from this margin, and had steel price remained constant at your sort of bid levels, what would have been margins, so that we can get a sense that there is nothing structural about this. It's only steel prices which are impacting your margins currently, because your order book is very, very healthy. So you should get operating leverage on sales very, very quickly, given what we are seeing in the ethanol space. So I'm still a little boggled by the fact that being a technology leader, having such great market share in the products that you are talking about, in the equipment that you're talking about, you're still struggling at the 8 to 10%. How much would steel be? I'm sure you'll be able to quantify that. Had steel been constant, we should have been at 12, 13, 14. I don't know that number, but if you can get the drift of my question.
Yeah, so I think let me try and help try and elaborate what I believe is happening. So the sugar-based ethanol, if you look at that as a major segment, which has been the case so far, is a very, very mature technology now. I mean, there's nothing. Yes, there are always improvements in any process plant that you can do, but fundamentally, it is a proven technology. Customers are very well aware of it. There is not a something sitting inside a black box that they don't know about and things like that. So there, the technology is only from the perspective of reliability, etc. That helps to build, and that gets then reflected in terms of market share. Right? But of course, there are competitive forces that are also at play, plus an ability of a customer to pay in terms of what. So these are sugar mills, sugar-based feedstocks. So that's the different dynamic at play. Now what we are seeing is the second part is now the product mix shifting, not shifting, but significantly getting added on by grain side of story, right? Where the customers are very different. They are not, many of them have never operated a plant before. There the technological play is also different because we don't have enough of experience in the country. While Praj has done a lot of plants outside India, inside the country is a very, very limited experience on that. So we will definitely see a shift on the positive side for the margins on that front. But that will start to play out now. The grain story is just beginning to flow into our order book. So when we start to execute, you will see that. Yes, steel price hike has been a hit for us, no question about it. As I mentioned that, so we are thinking that for the whole year's performance, it is almost a 2 percentage point difference on the whole year's sales for us. So that's the kind of impact steel price has got. So on the tech side that you mentioned about, I think the two things that are very important is, so 1G ethanol is one story, but CBG that we discussed a little while ago is where the technology was. But that is the business that is yet to start moving up, right? We just have the first 4 projects which are still under execution. One is commissioned, second is under commissioning, the 2 are under execution. So we'll have to go through that one cycle of starting the initial projects, which is high technology led. 2G, where the technology is definitely a global technology edge, but there we are waiting for commissioning the plant, because then only we can start to leverage in the world market, because nobody has commissioned a plant like that before. So the high technology point that we talk about are coming from businesses that are still not playing any large role in our sales mix, right? They are the businesses at the startup phase of the cycle. So that probably also explains to you what's happening on the margin side.
So if you look at it, you were at about 1,000 crore run rate, sort of flattish for the last few years, where you were in this 7 to 9% margin ranges. Now, obviously, both the 1G, 2G part of your business is accelerating, and even if we remove the steel impact, let's say instead of your 9%, you can, on a steady state, once steel stabilizes, make 11% margin on a steady state basis for that portion of your order book. And for the so-called technology, CBG, etc., where would you aspire for the margins to be in that part of the business?
Well, we obviously want it to be much higher than our very mature businesses, because where the technology is reasonably standard, the customer experience has been very, very rich already. Compared to that, something which is very new, that I won't put out a number out in the public space, because that is just not. But there are customers who can be listening on this call. There are competition who would know this. That is something that we won't share with you now. But obviously, directionally, of course. Is that?
Yeah. Thank you for your answers.
Thank you, Samir. I see a comment, and I would like Mr. Poddar to tell me if he thinks that the question is answered.
Thank you. So next in line, we have Mr. Rajesh Kothari.
No, hold on. I asked a question. I would like Mr. Aditya Poddar, he's put a comment there.
Okay.
I would like to know from him whether he has received the answer.
Yeah, no, actually, Shishir, I asked you on the call also, quarter 2, quarter 1 or something. Yeah. But I'm not satisfied. We're not satisfied with the order book growth here. I mean, see, this company is coming out of a hiatus of many, many years of no shareholder returns, correct? So the ideal thing would be, okay, with the kind of tech that you guys have and the entire story of ethanol that's happening in the country, the idea should be, completely focus on shareholder returns. Yeah, the stock has given great returns in the last, 6 months, 1 year, but I'm talking a 10 years horizon, right? So last quarter when we spoke, you told about order book was at 661 crores, and the order book 2 quarters before that was at 640 odd crores, something like that. So I was just asking you, how is that ramping up? How is that ramping up? How are you going to, how is this company going to grow, to 3,000, 4,000, 5,000 crore top line kind of a company, So that was the most, important part that I felt.
So Aditya, there's two things. One is like more a clarification, and second, of course, I'll be happy to answer. Is 2 quarters ago, that is the December quarter, is when it started. Actually, December of last financial year, when that order book was declared, if I remember the number correctly, is 540 crores, and in that 230 crores was one single order or zero equity discharge. So the bioenergy portion was much lower. Now, when I tell you 660 crore, 500 crore is the bioenergy portion. So obviously it is growing. There's no question about it. We haven't ceded our market share. There's a speed at which the market is growing. So even when we said 20% ethanol blending program, for it to become reality on ground, that it's a 4-year. Why do you think government said 2025 and not 2022? Because it takes that long to build that capacity. There are different issues of people availability, resources, feedstocks, tying up funding, project, multiple EC, the environment clearances that are required. So the project buildup is not that, okay, today it is 7% blending, tomorrow 20, so all the capacity will get announced on day one. That won't happen. It takes a gradual amount of time. And that is very evident. So if you look at our December quarter order booking, that is when we started to move, was of the order of 200 crores. We are now of the order of 500 crores. And you will see this order book, and this is consistently been building up. And you will see that, and I'm not withdrawing. I'm very happy to share with you that we'll continue to build on that, not retract on that. So that's on the ethanol side I'm talking about. So that's very clearly the picture that emerges. So from 200 odd crores, I had mentioned that even in my last call, that in the whole of last financial year, the country finalized 140 crore liter of capacity. In last quarter alone, they finalized 130 crore liters of capacity. And these liters are not, liters capacity is one, but there's no multiplier. Said, okay, so multiply so many rupees, that means this many got order got finalized. But depends on brownfield, greenfield, what feedstock, debottlenecking, many levers by which customers can actually improve the capacity. So that's the direct question there. Coming to then your question of, so that was more like a clarification to your observation. The other one there, you said that, look, for many years there was not very high shareholder returns, or we have been waiting. Only last 1 year we got some returns of the kind that is happening. All I can say at this moment is this, that yes, there are facts for everybody to see. We have always been a constantly dividend paying company. We have kept, even in some very trying circumstances, a high degree of resilience has been shown. So if all those qualities have got built, I'm sure that as we move forward and as the environment becomes favorable, we will be able to leverage that for good. And now, if I put a number out there today saying it is X percentage or Y, that is only still holding a crystal ball, right? All our effort are in that direction to make sure that happens. The leverage kicks in. The numbers that you talk about in terms of top line, ultimately it's a function of what is the total size of market that gets developed. So, and as I confirm to you, we are seeing constantly positive traction. So it's not that it's now stopped. It is still continuously building up. So from 200 and odd crore level, it has already come to 500 odd crore level, and we expect it will further go up as we move through the future quarters. And I'm sure that if we continue to go through that, you will see those numbers.
Okay. Thank you for this elaborate answer. Thanks a lot. And you find yourself tying up with some large MNC players where whereby you guys can get solid export order book traction, maybe for high purity. See, there are a lot of other tech efforts. So just wanted to know if you guys are planning to tie up or something, with some big guys abroad.
Yes. So very clearly, strategic partnerships with customers abroad is a very key axiom of our strategy. We have talked about our chemical process equipment and systems business, where we are focused on a very few customers, but absolutely the leaders in their business who we are working with. And we are beginning to, and it takes time for those to crack with those guys. It takes because they will first, of course, you'll have to present your credentials, etc., and everything. then you get one contract, you have to prove your credential on that one contract, they give you another one. When you do on 2 in series, then they start to upgrade you to take you towards the strategic supplier status. I'm very glad to share with you that with one of the 2 customers, we have already achieved that status. So that means you will start to see that, but these are long-term contracts. Like those are like the delivery periods could be 12 to 18 months kind of a time frame for those large agreements for CPES. So you will hear about it as we move forward through the year. Very well put question by you. There is no such thing as we are not seeing that there is one very large player who is deciding to put up 10 ethanol plants in the world, and then that possibility doesn't exist, because it's the structure of the industry is not like that. But on the large high purity space, on CPES, these 2 businesses definitely, yes, we would like to move in that direction, and collaboration is the way to go forward.
Thank you, sir. Thanks a lot. Thanks.
So, Aditya, I hope I answered the question.
Yes, sir. Yes, sir.
Good.
Thank you.
Hi. Just 2 questions from my side. First of all, can you tell me what is the order book execution for bio side, engineering side, and high purity side in terms of the time period typically?
So, sorry. So let me rephrase. You are saying how long does it take for us to execute a job in these 3 segments?
Yeah.
So typically a bio and if it's the first generation ethanol project, we are looking at a 10 to 12 month time frame from the time we get the contract. If it is the second generation, then the time frame is quite long. It could be of the order of 24 months. If it is CBG, it could be of the order of 10 months. On the engineering businesses, depending again on the degree of complexity, etc., and the volume, so it could vary from anything between 10 months to 18 months.
And high purity?
High purity is short cycle. High purity is maybe of the order of 3 to 6 months.
Understood. So basically what I'm trying to understand is that, the most of the orders, whatever you have booked, considering that, you are one of the largest player, and this increase in raw material prices is absolutely across the world. It is not only for our company, but it is happening through the world. And, most good companies, irrespective of which business they are able to pass it through, maybe with a 1 quarter lag, because it is an unprecedented price increase. So, and anyway, you are leader. It is not that, you are competing with another 20, 30 players who can actually undercut you, which is not possible. If they undercut, probably they will go bankrupt, because even you are making only 10% margins. So what is the, what is the constraint from your end to pass on this price increase to the customers? That is number 1. And number 2, you mentioned that 200 bips impact on margin. So you are saying that from FY21 levels, your margins may get impacted by 200 bips. These are the 2 things I wanted to get clarification.
So in terms of the first question that you asked, Rajesh, so today when I go and book a new contract, let us say so it is based on today's steel cost. Okay, so that flexibility exists with us. That is not a problem at all. That pricing power exists with us, because if I finalize a contract today, but if I finalize a contract today, obviously by the time I come to steel buying or components buying, it is at least a 4 to, because engineering has to be done at least 6 weeks. In that 6 weeks, if the price goes up, I do not have a formula built into our contract with our customers, because that's not the structure of the industry, where they'll allow me to say, all right, I gave you an order. Today you are going to finish your engineering, and then from today onwards, we'll have a new price equation built in for the escalation. So that capability or that ability does not exist, because that is how the industry structure is. But when I book a new job, sure, I am looking at the new steel price. So it will probably catch up. It's not 1 quarter lag, because when we started the year, we had an order book of the order of 1700 plus crores in our hand. That those orders have to be executed by us, and many of them are going to experience and are experiencing the increased prices of commodity. So on those contracts, I don't have any flexibility to go back to customer and say, hey, please increase my prices, because we have a fixed price contract. But once that the new contract that are doing, they are coming in at the new steel, at the latest steel price. Let me put, not the new, but the latest.
Of course, I mean that's part of any business. Of course, the new contract has to be at new prices. If it is up and then higher, if it is lower, then lower price. I'm not talking about that. I'm talking about the in between. You mentioned that the cost has gone up and therefore there is an impact. Now, what I understand, the contract normally you would be getting on everyday basis or every week basis or every month basis, right? And therefore, to that extent, the prices also keeps changing, and you keep building that depending upon how the things plays out within the raw material procurement kind of a policy. So why it can be such a high impact? Because it is not just one contract which you got last year which you are executing, right? It must be a number of contracts which you are executing.
Just give me a second, please. Just 1 second. Is it possible for me to share a screen in this call? I just want to ask the organizers, please.
Yes, sir, you can share. Tarak, please give the screen sharing right.
But it says you're disabled.
Just a minute, sir. I'll get it.
Rajesh, I just am wanting to share some information, and that's why I'm waiting for.
Sure.
It will help us to get a richer answer. Okay.
Sir, it's done. You can do.
Yeah, you can see this curve, guys. Are you able to see this curve?
Yeah.
Yes, sir.
Okay, so see, this is the SSRM rate. Okay, look at what is happening to steel prices, and it just starts to rise here. It was fairly steady up to December of 20, and the first jump came November to December. It became a little steady again up to April, and then just see this. So from a level of 160 odd in October, November, it's now at, and this is the curve, not latest, the latest price 245. The problem is that this changes is that the changes are happening literally on every alternate day basis. This is some point that we have plotted. But I just wanted to understand that if it was a one-time price increase, it is much easier to tackle. If it is a continuously rising curve, then it's going to hit your all your existing contracts, irrespective of when you booked it. Okay, so I just thought that I'll share that information
Sure.
with you.
So do you think that it makes sense, therefore, to enter into the price contract where you have a flexibility rather than the fixed steel index? That is number one. And number two, as the steel prices increases, while your margins may come down as a percentage, but actual your revenue in absolute terms will also increase. Correct. So to that extent, actually, it adds hugely to your EBITDA, because your steel price itself has gone up by about 40, 50, 60%. So how do you see this? Going forward, also this problem may continue. Who knows?
Well, we have to see that, and as to how the steel prices develop, we'll have to find. We are finding different mechanisms to cope with it, to overcome this. But while the prices can rise instantaneously, the mechanisms that I have pushed in play may have a differentiated time lag in terms of when they become impactful, right? So that's the first answer that I will give to your question. The second is about do we want our contracts to be fully variable on the input cost? Well, by all means. The question is, are the customers ready to do that? And they may not be ready to do that. They are not ready to do that actually. So because they also have other challenges to overcome on their end. So yes, rising commodity prices put a challenge to everybody. No questions around it. We are also an industry that is highly customized solutions. We are not mass production systems. In mass production systems, it's much more easier to absorb and pass on the price changes, not so much in customized systems. So these are the common challenges that any capital goods equivalent or process plant company would face, and we are no exception to that. Having said that, I think we are very conscious of this, and we are also conscious of the fact that as the number goes up, I think somebody earlier also asked, I think Mr. Poddar asked the question that regarding the leverage that could kick in, and we are saying that yes, it will start to kick in as we go through the year, and you will see that happen as well. We have already started their journey. The question is, at the end of the year, the leverage benefit that we will get versus the commodity price hit we'll get. We are saying today, we are saying it's a 2 percentage point hit. If the commodity prices do stabilize, then maybe with a lag of a couple of quarters, we will see that hit vanishing, and you'll be able to see an improved margin picture.
So just clarifying, this 200 bips is compared to FY21.
Yes.
On the annualized basis, yes.
So you mean, so FY21 margins are 8.6?
Yeah.
Right? EBITDA margins I'm talking about.
Yeah.
So you are saying that ideally you would have got 11%, but now you are going to go back to 9? Or, what is the, can you clarify what is the 200 bips, from what level?
No, so if you look at this quarter, my EBITDA is around 8%, 7.94.
Correct.
Yeah.
That's
So
on a very low revenue because of the seasonality. So I don't think one can.
So there is no question of a seasonality in this quarter, because if you look at the top line, it has taken care of all the seasonalities also. And the first quarter revenue is very different as compared to any first quarter revenue for past many years.
Okay.
Yeah. So the margin which has got impacted, we said that when we are talking about EBITDA of 8%, it is post taking a hit of commodity prices of 2%.
Okay. And then the new orders would have the new margins. So new orders would be at. So are you trying to say that your peak margins therefore is 8 plus 2, 10, 11? That's it.
So there is no question of specifically.
No, but that's what see, everybody's trying to understand that. Am I right?
Rajesh, please try to understand. If it would have been a very standard, standalone, steady business, I would have given you this number. But there are many levers which are playing along with the ethanol business also. For example, we are executing 2G project at a different stage. We are executing CBG project which just got introduced now. So there are multiple variables which are playing a role in this entire revenue stream. It is not only an ethanol one standalone stream which is playing a role. There are multiple players which are there in this stream.
And as I was explaining to you earlier, that if you're a single line business, then your observation is very correct. But it is not a single line business. So we will see different businesses start to pick up steam at different points of the curve, right? Like I was saying, CBG is a startup phase, 2G, once it is commissioned, maybe next year. We will see CPES business orders flowing in as we move through the year and move through this financial year. So you will see that the construct of the business mix plus domestic versus international plus what happens to commodity price is a mixed bag of all. So the 8% result that we gave in first quarter was after adjusting for these numbers. We are not saying that it will go down from here any further or anything like that. Actually, as our sales are likely to move forward, a higher amount of leverage may kick. But we'll have to see how that develops and how it offsets against the increase in the commodity prices. Because if I were to say that, nothing will happen to commodity price from here onwards, that will be a foolish statement because we don't know what.
Thank you, sir.
Thank you, sir. So next in line, we have Mr. Ronil Dalal. Sir, you can ask your question. You can unmute your line.
Yeah, hi, sir. Thank you for taking the time. Is my line clear?
Yes, Ronil, very clear.
Yeah, so my first question is that I think it was asked earlier, but the current capacity that you have, what kind of revenue range would we be looking at from that? Supposing you are having orders in excess of your ability to execute them. I understand there are different projects and all, but if you were to give a range, what kind of revenue range would that be?
So, I mean, of course, as I think you put that in chat box as well. It depends on the product mix, etc. But up to, let us say, if we were to go to 3,000 crore plus minus 20% here or there, then we don't worry about capacity creation yet. Okay, we are good and we are covered for that part. Also, I just want to clarify, since you made a statement, and I'm sure that you didn't mean it that way, but we will not book an order if we can't execute it. We will not tell our customers something which we cannot fulfill, right? It's a matter of value for us. So if we do commit something, we may go and tell him, no, not 10 months, it'll be 12 months. But if we do tell them that it will be 12 months, then it shall be 12 months. That's the principle on which we work. So we will not take orders beyond our capacity. Either we build the capacity or we don't take the order, but we won't do the thing that, okay, let's take the order. If we don't take capacity, let the customer act. That won't happen.
Right. Yeah. So the second question is that, earlier there was a scheme that was announced whereby some of your customers were able to access subsidized rate of interest for setting up ethanol project. So the last time that was we checked, I think there were not too many takers for that scheme. Is that still the case, or am I missing something?
No. So the way the scheme was, it was an interest subvention scheme. Okay. So
Right.
you take a project, you build it on a debt, and then whatever debt you've taken, there will be interest subvention that will be available, and there were prescriptions given 50% of the interest rate or limit, etc. So those were specified in the details of the scheme. Now, if any customer who will put up a project would obviously want to take that advantage, right? And when they do their financial calculations for viability of the project, I'm sure many of them have done that, and some of our customers have also taken what I would call as have applied for that, and they have sort of built their project finances around their subsidy. But by itself, interest subvention does not drive project capacity creation, isn't it? Except for the fact that it makes the project that much more attractive. So for bankers to fund it, etc. But it doesn't create the capacity by itself. For that, the equity has to come in, the debt has to flow in, the project feedstocks have to be lined up. So there are other factors which are, in my mind, probably even more important than having it. Interest subvention is more like a incentive for people to create fast capacities on ground.
Right. So my follow-up to that is that does this mean that despite the incentive which has been offered, there are not too many applicants, means there is not as much interest in setting up the ethanol plants?
No, there is a lot of interest, and that's what I was mentioning earlier, that we have seen that. So, for example, when grain was released as a feedstock by the government, right? Let's start tracking from there. So, the day it was released, from there onwards, we have seen a absolutely significant buildup of the interest. That interest comes to inquiries. The inquiries will start to flow to orders. And as mentioning, as we travel through the year forward, we expect much more to happen on the grain side of action. I was also mentioning that even sugar companies, leading sugar companies, are now thinking of putting up a combined project, right, where they will have both sugary feedstock and starchy feedstock. So we will see that development happen. From the time the feedstock was released to the time the project actually gets finalized and built on the ground, obviously there's some time lag for obvious reasons, because it is now pan-India. Anybody can actually, based on grain, literally anybody can be producing grain-based ethanol. Yesterday, I was with a very unusual group of customers who you never associate with producing green energy, but we were talking to them and we finalized a contract with them. And they are a very, very significant business group, but they have no past track record of being ethanol producers. But they want to do it now because grain makes it possible. With sugary feedstock, that was not possible unless you have a sugar mill. So we'll see that development very constructively happening as we move forward today.
Right. And my third and last question is that what would be the latest order book, and how do you see it shaping up in the year? In maybe if you say like from a 1 year as well as a 3-year perspective, just your thoughts on that.
So Ronnie, as I was mentioning that, I think somebody actually put those numbers, and I hope I remember them correctly now, that we have seen this gradual from 540 crore onwards to 600 crores to 661 crores kind of a journey that we've undertaken on the order book. And as I said, we expect that to continue to build forward and not backward. So that is the one indicator to you that it is still continue to build more favorably as we move forward on the order book part. Our aim is that every quarter we must add something to that order book so that it becomes more positive as for the future quarters to come. And that is our attempt. We do not have a practice of sharing midway through the quarter our order book, so I won't be able to do that. Except to tell you that this quarter also we know for sure now that our order book will build more favorably compared to previous quarters.
Also, just linking your first and third answers, just so if you would not take on, say, orders which you cannot execute, So in keeping with that spirit, so would there also be a maximum order book that beyond which you would not like to go till you then announce a new capex or something like that?
Well, what you're saying is right, but as I mentioned that right now we are in a position to execute orders of between 3,000 3,500 crore, of course, depending on the mix. So, and we are not at that level yet, so we are good. And as we start approaching that level, we will very quickly bring in, because it'll be silly on our part as management to not foresee what's happening in the market space and build our capacity accordingly. So we will take those steps. We are not at that stage yet. Our current capacity is able to take us to a level of 3,500 and thereabouts. So I'm not worried about that yet.
Right. And is there any internal target or aspirational target in terms of when this kind of revenue might be achievable?
And of course, we all have very high degree of ambition and aspirations, and we are all working to improve from where we are and do better than what we are. No question about it. I'm not at liberty to share the internal numbers because that's not part of our strategy. But yes, of course, we all have significant ambitions inside.
Sure. Thank you so much for your time.
Thank you.
Thank you, sir. So before I take the next question, I would remind participants they can raise their hand to ask the question. So next in line we have Mr. Levin Shah. You can ask the question, Levin.
Yeah, hi sir. Thanks for the opportunity. Sir, first question is on this Leafnity tie-up that we had done. So we had signed an MOU for putting up 10 CBG plants, and one was under works immediately, and there was this MOU for 9 other plants which are supposed to come up. So where we are in that MOU, have we made any progress, and by when do you expect those plants to come up?
All right. So Levin, the first project is under execution right now. As I speak with you, all equipments are at site. Nothing is pending from our end now. And of course, there's some work that is to be done with the customer end also. So they're rushing through that. And we are expecting that somewhere in the month of October, end October, we'll be able to start commissioning of that project. And once that is done, they are also saying that we would like to see one, because there is no experience on the ground for unlike ethanol plants, where there's tons of experience on the ground. There's no experience on the ground for CBG, so they're saying we want to see one. They are also now working with some of the CGD companies, etc., in the region to see how they can evacuate the gas. So they are very keen that they would like to see one getting commissioned and then take the thing forward.
Okay. So by this, do we expect that work on the balance plants should begin by the end of this financial year, or it will flow through to next financial year?
So Levin, we have an MOU for 10, we don't have an order for 10. So in order to execute, I will need an order, but I'm very sure that once the plant is commissioned, it starts running trouble-free. Customers will then take up the second and third and the fourth project, and we'll be able to help them build that up.
Right. Sir, and how many CBG projects are under execution right now? So we have just completed the first one, like you had announced in the previous quarter call as well.
Yes. 3 more we are currently under different stages of execution. One is Leafnity and 2 more. HPCL.
Okay. Yes. Okay. Sir, and second question is on the RCM business, or the renewable chemical business that we had announced somewhere in July, August last year, where we had said that within next 1 year we'll launch products under that. But I post that there has been no announcement on that front. So where we are in that product range?
So Levin, we had said that RCM is a business area so we were very clearly in the space of renewable bioenergy products, like ethanol and gas and diesel and things like that. So those are all energy products. Then we said we will also enter into the platform of chemical and renewable chemical and materials, which is a very fast area of great interest, increasingly world over. So that is what we announced at that time, and then we'll start our R&D, because that is where we do. So our announcement was about our intention to set up a separate RCM vertical and start work in that direction. We had and it starts with research and development part of that business yet. So that's number one. Number two, RCM is a business where the world market is still under nascent stage of evolution. So as we move forward, we will see that the market itself develop in a significant sort of direction. Number three is There are products that we have announced and used, and of course, it's a cycle that one needs to go through and check. But just to give you an idea, so we had, if you would recall, we had talked about biobitumen as one product launch that we did. Before that, we did lignosulfonates. So these are all products that are coming out at different stages of the cycle. There's a small, I would get a small bag of products and technologies that we already had with us. There are some which are coming out of this co-product routes like biobitumen and lignosulfonate. And then there's a third one, which is around PLA and bioplastics and other routes that will come through other biochemicals. That is for which we are still under this work of development. So we're developing the process, the molecule, the engineering of that. So once we are ready with that, then only we can take it to market. And that is still some time away. We are not envisaging any business out of that in a very near future.
Right. Okay. And sir, our forte in that would be to provide technology, or we will get into manufacturing of those products, or it will be really restricted only to technology?
No. So these are the questions to which I don't have a definitive answer. Both are possible because it depends on how the whole ecosystem for RCM and that particular molecule that we discovered develops. What are the volumes? What are the dimensions? Because is it a single location production molecule, or it is a multi-location production molecule? Is there a single customer offtake, or there are multiple customer offtake? There are different dimensions that will come into play. We will have to see how it develops. Right now, we have kept our options open. We will see what's good for the company and what's good for the business. That's what we will do. We are not shut ourselves to any of the options.
Okay, got it. Sir, and last question is on the exports market. So we have seen during this COVID times, because of the restriction on travel and even like new projects announcements had slowed down. So have we seen some pickup on that front, or it is still muted in the sense that order booking from the exports has been weak in last few quarters?
Yes, you're absolutely correct, Levin. So as I was mentioning in my opening remarks as well, different economies are taking different curves to come out of this pandemic-related economic slowdowns, and we are beginning to see some opening now in couple of markets, but it's not back to normal business yet. I think that is still some time away. The vaccination rates are different in different countries. So we'll have to see how the overall thing develops. But yes, export markets are coming back, though not they are not at the same level that they used to be before, but they're definitely positively constructing in that direction.
Right. So progressively, there would be some improvement in terms of inquiries as compared to what we had seen in Q1, let's say.
Yes, of course. Yes, of course.
Yeah. Okay. Okay. Got it, sir. Thank you. Thanks and all the best.
Thank you, Levin.
Thank you, Levin. The next in line is there's a question in chat box from Mr. Rahul Paliwal. Mr. Rahul, you can ask question directly if you want.
Audible?
Yeah.
Okay. So my question is, sir, on broadly what we see in Praj is, so far our experience in a commercialized world is about 1G, right? We are scratching the surface so far in technology terms on 2G, compressed biogas and other opportunities, right? So, and while we were working on ethanol, we come across opportunities in terms of innovation and inventions, and we have the patents, right, from bio-based chemicals to plastics and bitumen and so on, right? My question here goes, we don't have much experience in exploiting the opportunities in biotechnology world. So how we are looking to materialize in a way that we don't get bump ups or failure in between in terms of exploiting these opportunities which are in our lab or Praj Matrix front. And it's fair to go and see if we can take a help from some PE and induct and can reach out to a wider scale geographies, and that will be a better way. So that's a question to you, sir.
Just one second. That's a great question, Rahulji. Let me try and articulate. Yes, biotechnology is a very, very exciting area. That's something that we've been doing for years together. Of course, the one big success that we've seen is the 1G technology, no question about it. 2G also, I'm just sharing pure information. The only company in the world which is building 3 plants right now for 2G for external customers is us. No one else is doing that. There are 2 or 3 of our competitors, but they're all building their own plants, which they are the owners. They are not doing it for somebody else. So there is some, of course, as we move forward, we'll get even more richer experience, and no project does not teach. Every project will teach us something or the other. So from that perspective, of course, we will keep on evolving ourselves. So yes, when we go to RCM space, there will be very different dynamics that will be at play. And I think that was also apparent in the previous question that was asked by Levin about the whole RCM space, whether we will only license technology or will also participate in manufacturing. So yes, those are the questions that we need answering. We are not at that stage yet, but of course they will need answering. For the RCM business, I just have absolute pleasure in sharing with you that we are very, very, apart from the company's normal board of directors that we have, for RCM business, we have a special advisory board of absolutely leading experts of the world as members of that, who are advising us on what needs to be done in terms of who do we partner with, who do we work with, who do we collaborate with, who do we co-develop with, who do we share with. There are different dimensions to this whole space that they are advising us on. Right now, and P is just one dimension, right? P will bring one dimension, but we have to be mindful of the different dimensions that will come at play. And we are very cognizant of that. And I assure you that the company will take all steps that are necessary as and when the opportunity of the time arises, and will not hesitate from doing what is right for the company and its interests. So absolutely well said by you. And all I'm saying is, whether it is a technology collaboration, whether it is partnership, whether it's co-development, whether it's co-ownership, whether it's infusion of funds, whether infusion of knowledge, whether it is management of relationship, there are different dimensions that will come into play, very different than what we've done so far. We are cognizant of those, and we will address them as and when they come across. We have taken some very basic steps which are absolutely necessary in terms of forming of advisory board of directors, etc., board of advisors, which is very, very prominent set of people. They are not only one of them is here and also very prominent, and other 2 are outside India, but they are all advising and guiding us. We have our partners with us, with whom we have, like GEVO, like CCAB, like DVO. We have many partners with whom we have partnered for technology. They will also be participating at different moments in time as and when the situation so demands. So we will make sure that we take the right steps.
Got it, sir. So my probably one of the context of asking this question was, probably we are looking at firing one engine as of now, as a 1G, right? Where probably in a decade kind of opportunities in front of us now, after working almost for 15-20 years, we have got this opportunity. At the same time, we see mega trend in terms of bioeconomy, coming up in front of us. So this will be a kind of parallel opportunity, right? So if we put our all energy in one side, let's say 1G, and exhausting ourselves, probably we will end up with losing those kind of other opportunities. So you need to have probably 5 or 6 new Praj verticals having same kind of management bandwidth and same kind of talent pool to exploit this kind of opportunity, which is Praj Matrix is generating for you. And as the climate issues and Paris climate and everything is popping up in front of us. So we have a lot of opportunities opening up all of a sudden. And so the question about our, in terms of our capability to exploit them. So maybe you can.
Very, very well said. Very, very well said. And I think all I'm assuring you is that we will do whatever it takes to ensure that we realize our potential, that we are able, but Matrix has to develop a process. We have to convert that through engineering into a commercial proposal, and then take it to the market. And as I was saying, on the RCM side, it is still at R&D stage. That's number 1. Number 2, which is equally important, and I'm just building on what you said, is that we are not firing one engine. We are, and I've said this in the past, we are very clear that for us, ethanol, gas, ZLD, CP, each of our business is like a pearl of strings. Yeah, the string is made of different pearls, right? Different pearls on a string. So each of our businesses, we want to take them to their natural ability and their potential. For some businesses, for 1G, definitely there is a tailwind right now created in the country, and we are making sure that we are ready for it, because I have to be ready for it. This is our core business. You yourself said that for 15-20 years we've been building this up, and I'm sure that if you were to look back at a call 10 years ago, people would have said, why are you doing this? There is no business visible. But please give us credit for understanding. We have, we forget these things very easily, but please appreciate that the world knows that they have recognized in form of the Carver Award with Dr. Chaudhary won, which is actually reflective of the fact that they believe that we are at the leadership front of this development. It is not a firm business proposal yet in the world. People are talking about it. There's newfound consciousness, as you said, with Paris Accord and climate change and these issues. And as we move forward, yes, that's a good positive development for the ecosystem of our business. And as and when opportunities open up, we will make sure that we are not found wanting for want of resources or the right. We will not hold that.
Thank you, sir. And as a shareholder, we wish you all the best.
Thank you, Rahul.
Thank you, sir. So before we get any further question, just one question from my side. Sir, we are a strong player in the bioenergy segment. And just want to check, are we looking for any other segment in the green energy space apart from bio? Are we thinking in that direction? Like hydrogen is very much talked about.
Yes, Pankaj. So as I mentioned, but hydrogen is 10 years out. Okay, it is not here now. We're talking about it now. But so there's one is this electrolyzer route. Take water, do the electrolyzers, and create a green hydrogen. Okay, and you create tens and even if you look at all the plants that are announced in the country right now, it will not be enough to meet even 10% of the hydrogen demand. Okay, plus the ecosystem has to again what we are experiencing CBG, same thing has to happen, right? You need to have a vehicle that runs on hydrogen. That is what you want to do with the hydrogen production, right? That's the second part. Number 3, what is very important, and we believe we just had a dialogue with we were invited for a dialogue with Niti Aayog, and we have gone and mentioned and shared with them how India can actually leverage its prowess on biomass, because that's something that we have plenty of, and we can use that for production of hydrogen. CBG is the first step for that. Further processing of CBG that gets produced will lead to hydrogen formation. We are working on that program in a very active way, and we are very sure that as things unfold and we move forward, we will also have a significant solution to offer in this space.
Okay, thank you, sir. I think
Pankaj, Rasmi here, can I have one last question?
Yeah, please.
Sir, I just wanted to understand, that last year we had around 300 crore liter of ethanol production. And if you have to go by the 20% blending, this needs to go to 1,000 crore liters by 2025. Just want to understand, in terms of KLPD, how many plant ordering has happened, which can bridge this gap of balance 700 crore liters. So just wanted to understand from the remaining potential demand of 700 crore liters, how much of that has got ordered by various players from your market intelligence? If you can just help us that.
Yeah, sure. No problem at all. I have already given that figure, but maybe I didn't put it that way. So the actual number is that we need to create capacity for 1,000 crore liters of supply, okay, to bridge the gap from where we were to where we want to. That is, when we finish at 20%, we should have added 1,000 crore liter worth of capacity in the country's production plants. Okay. Now, from that perspective, if you look at it, we have said that 1,000 crore liters will come from different feedstocks. So initially, the sugar plants were there, the change in feedstock for them, right? They actually had to do little. So they were all molasses C based plants. They switch the feedstock to molasses B and the production goes up 20%. They fix it to syrup and production goes up another 40%. So that was one wave that we have seen and we have experienced, and we are experiencing it now also, partly. That is going to create the capacity. Now, as I was mentioning earlier, we'll see grain-based capacity buildup, which will be all greenfield plants. Then obviously the project outlay and size will be much larger than what we have seen so far. That's the second thing that will happen. The third is, I mentioned that to you, that last whole year, the country ordered out 140 crores liter worth of capacity creation. We have seen 130 crore capacity creation being ordered out right now in the first quarter that it ended. So 250 odd crore liters worth of capacity is already in making, if I can use that word. As we move forward, we'll see how that goes. So we still have to reach 1,000, and for 1,000 to be delivered, we'll have to build something like 1,400. Then only we can deliver 1,000 out of it, because of seasonality and not everyday running, because these numbers are required every day, right? There are no holidays for petrol pumps.
Okay. Okay.
Or ethanol pumps, if I can use that word, yeah.
Right. So that's helpful. So another, maybe I'm not so strong on the technical side. I just want to understand that if in the next 3-4 years we have 20% blending of ethanol with petrol, will the existing engines be able to probably, cope up, or probably the customers need to tweak the engines? Because recently we saw the ministry, asking all the OEM car manufacturers to make flexi engines available. So existing engines, will they able to, run petrol mixed with 20% ethanol, or they need to tweak the engine going forward? Will that be a constraint for ethanol blending?
Yeah, so let me share this with you. So flex fuel engines that is being talked about will actually permit you to use 100% ethanol or 100% petrol and anything in between. That's what flex fuel engine is all about, right? So, and this technology already exists in Brazil. Most of the fleet, in fact, 65% of the fleet there is on flex fuel. So you can drive up to a pump and decide what you want to fill in your car, 100% petrol or 100% ethanol, or a mix in between. E20, E50, it is your choice as a car driver, and depending on, because you know what duty you want to put your car to, so accordingly you decide what fuel you want to fill up in your tank. And in Brazil, they are all at different price points. Today, when I and you go to Indian petrol pumps, there's only one price point, right? More or less. So that's not the case if you go to multiple. So that's about flexible fuel engines. Okay, so when flex fuel engines come, we will see this ecosystem develop as well. On the existing 20% blending, the engines will remain, but there will be a need to change when we go to 20%. There will be a need to change all the gaskets and rubber parts which are on the fuel drain of your vehicle, whichever vehicle you have. That will need changing, because that may not last. That will need changing. But other than that, nothing. In order to gain, see, when you are putting a fuel into your engine, you want to get maximum out of it. Whatever that maximum definition is, torque, power, efficiency, mileage, or a combination thereof. This maximization can only happen when it's a new engine. In an existing engine, because it was not designed for this fuel mix, you'll have some or the other compromise depending on what mix you are using and what engine you are using, how flexible that, or what's the range of that engine itself. There are some very positive aspects of ethanol mixing, like it releases oxygen when burnt, which is very good for burning of the rest of the petrol, because oxygen is obviously an aiding agent. It has got a very high octane number, so that allows the engine makers to go to higher octane numbers and therefore higher compression ratios without adding any additives into the fuel. So that's a very positive for the designer. So if they know upfront, they will be able to design engines for high compression ratios and therefore more efficient cars. But the old cars will not be able to leverage this particular aspect of or ability of high octane number and therefore high compression, because their compression is not prefixed. So to that extent, they will not be able to gain advantage.
Thank you, sir.
Thank you. Thank you.
Thank you, Rasmi. I would like to thank the management of Praj Industries for giving the insight on the company's business. And I would also like to thank the participants for joining the session and making the session more, discussion more interesting. And with this, we end the session. Thank you, sir.
Thank you. Thank you, Pankaj. Thank you, everybody. Thank you for great questions. It really helps us. Thank you so much.